Hello, so this week marks the 20th anniversary of what must be the worst investment decision of any developed world leadership in modern times. Gordon Brown's sale of Britain's gold at the bottom of the market. In May 1999, the new Labour government, with Gordon Brown as Chancellor, began selling Britain's gold in a decision taken against the advice of both the Bank of England and Britain's bullion dealers. And over the next 3 years, Brown sold 56% of the UK's bullion reserves. To be precise, that's 401 of the UK's 720 tonnes. Now, instead of selling and then announcing the sale after it was complete, Brown announced the sale to the international markets beforehand, and so the effect was to drive the gold price lower, to a price not seen since 1979, 20 years earlier. The average price achieved was $275 per ounce. Now today the gold price is $1,000 higher per ounce. So that decision has cost Britain this much so far. And today that low is known as Brown's bottom, and here we illustrate it in this 40-year chart of the gold price. Now, Brown has since justified his decision, saying that the gains he made in other currencies more than made up for the loss in gold. But given that gold was just about to begin a 10-year bull market against all currencies, I really struggle to believe that. It would have taken some extraordinary forex trading to beat gold over that period. And still to this day, I do not understand why those decisions were taken. There was no need to sell the gold. The government wasn't under any extraordinary pressure at the time. Not only was there no pressing need, Brown was repeatedly advised not to sell, so why he then went and sold is mysterious. One explanation is that the aim was to provide both moral and financial support for the euro at its birth without actually having to join. If that's the case, it's not a good enough reason. But that sort of absence of need is why many have gone on to suspect that his actions were taken as part of a global conspiracy to suppress the gold price. It's possible, then again, it might just have been a very stupid decision. We all make them. But the episode does show one thing, however. There are people who get gold and people who don't, and Brown clearly didn't. As gold has lost its role as the backbone of the international money system, its significance as a strategic asset has faded in the minds of many. And maybe it is an antiquated irrelevance, but even if it is, gold will always be the money of last resort. And in that regard, it's extraordinary that a chancellor would disband a national asset of such potential importance so unnecessarily. One day we might need it. Now, believe it or not, I had some personal contacts high up in the Cameron administration, and I was repeatedly urging them to use some of the money they'd printed via quantitative easing to buy back the gold that they sold. But needless to say, my plan fell on deaf ears. And that brings us to today. Gold is stuck in a range. It's been stuck in a range for 6 years. It's gone nowhere. There's been full storm after full storm, but all rallies have ended at about 1360, 1370. Now, for 10 years between 2001 and 2011, gold was the go-to asset, the must-have bedrock of any portfolio, and gold miners gave you a bit of fizz. And that all changed in 2011 when gold hit 1920 for no apparent reason, apart from the fact that it had run ahead of itself. Gold just stopped going up and it started going down instead. And there were plenty of reasons why it could have continued going up: political crises in Europe, zero interest rate policies, money printing, asset price inflation, all the usual reasons were there. But gold, it just fell. And the skids really kicked in 2013, and then the eventual low came 2 years later, 2015, at 1060. But viewed in isolation, the last 6 years have been the story of an asset going nowhere. And there have been bull markets galore elsewhere: 3D printing, Bitcoin, cannabis, battery metals, Bitcoin, you name it. But gold, nada. Now, there's always this narrative that the time to buy gold is when nobody else cares. Nobody else cares now, but nobody's cared for 6 years. And every year we get a little rally, everyone gets excited, the price rises $100, $150, then it runs out of steam. And the same thing happened this year. And I wrote an article about it, and it had the title, written not by me, but by John Stepek, who writes all my titles, "The Gold Bulls Are Back, so let's just be careful out there." Now, I've got a large part of my net worth in gold. I'm glad I do, because it's protected at least that part of my portfolio against Theresa May and Mark Carney, but I'm thinking in sterling terms. In dollar terms, gold's, it's not a bull market. It's stuck in a tired range. It'll have its day again, but a stagnant market is a stagnant market, and there's not a lot you can do except wait for attitudes to change, which eventually they will. So even if you roll the trading part of your portfolio in and out of gold according to circumstances, I still think you should always keep a core position. Selling it down was the mistake that Gordon Brown made. But at the same time, I don't think we're ready for a sort of another multi-year secular run in gold. It will come, but I rather expect a sort of couple or three more years of what we have now, range trading. If we get through 1360, 1370, I'll change my mind. But for now, that's the wall. Every year, however, the summer months usually provide the annual low for gold. And if you look for lows in that sort of May to August period, with a view to offload in the autumn or winter for a 15-20% gain, that's been a viable strategy. So I'm looking for oversold summer markets in gold. And greater minds than mine may disagree, but that's kind of about as excited as I can get about gold at the moment. Big bull market, I just don't think we're there yet. Sorry.